an article on Substack about the different bits of financial knowledge that a 20-year-old might find useful, and I really wanted to share this with you. I started working at the young age of 19 years, and as a kid growing up in middle class India, this is not a common occurrence. The fact that I was paid to work, and receive real money, uh, makes this even rarer, given the piss poor scenario of the unpaid internship market nowadays. Uh, but working was not really a choice for me. I lost both my parents at a young age, and being raised by my retired grandparents, who spent whatever little savings they had solely on my education, kind of forced me very quickly to become, sincere regarding making money and elevating my living standards, to basically support them and people in general who mattered to me. Uh, so whenever I got the chance, I tried doing whatever paid work I got in college. I was working, but then I was also pursuing my degree on the side. And while often the pay didn't, really add up, it was not much. I did whatever little I could to support my family, or at least make sure that I never had to bother them for my basic day-to-day needs. Like food, or if let's say I want to buy some headphones or a phone. At least I did not want to bother them about anything other than the fees which they were helping me pay for my college, right? uh, so but today in 2024, I have thankfully reached a reasonable and comfortable position financially, working a software job at one of the top paying MNCs. uh, Life is relatively comfortable now. Uh, but initially, the reason for pursuing money was, just to meet my bare minimum needs, But I have now realized over time that money is no longer just an investment for buying comforts. It's actually, like, for me, it's an enabler of freedom. And you should care about your financial freedom, right? At least I do. While I know that some of you might think that happiness can't be bought with money, but freedom really can, right? And I'm really happy when I'm free. Freedom means having enough money to take a 2-hour flight when you'd otherwise be taking a 36-hour train. From my hometown to my college, it used to be about a 36 to 34-hour long train ride. And I hated that because I used to always fall sick because the weather would change in the middle, and it used to be very tiring. The food was not that great. Uh, so not having to go through that experience is also a sort of freedom in my book. And it also means being able to skip the crowd and get the most comfortable seat at your favorite artist's concert, things like that, little things. So over time, while my hourly income increased, yeah, and you need to start thinking of the money that you make, and start weighing it against the time that you're spending to accumulate that wealth, right? Otherwise, it's very easy to get lost in this race of continuously chasing higher salaries and stuff like that. You need to find out, if I'm getting this much money, what is the time and effort that I have to spend to get it, right? So while definitely, like, if you think of it as an hourly wage, for me that has increased over the years by many folds. But if I think of it really deeply, I have considered how can I go even further and optimize even more. Uh, and for that, I have watched tons of videos and read a bunch of books about how to grow my wealth further. And in the end, in my opinion, it's not about how much money you earn, it's more about how much money you get to keep at the end of the day. And I have followed many friends' advice, invested in some good assets, some bad assets, some questionable assets, made some good and bad financial decisions, and also made some profits and lost the money a bunch of times. But it has been a journey which taught me a lot. And over time, I have developed a blueprint, which, in my belief, is the best strategy someone in their 20s can follow to end up with a relatively good enough financial situation to, insane wealth. Uh, but the kind of people who would roam around in a Lamborghini in their 20s. So using the different books that I've used to upskill myself over the years, I have understood that, okay, if you have this sort of a life goal, you need to mold your life in a certain way. You need to take your decisions in a certain way. But if your goal is, let's say, crazy money, crazy riches, your approach has to be somewhat different, right? Otherwise, you will not get there. Uh, So, either way, there are certain things which are common across those different ideas. And I just wanted to share this blueprint that I have in my mind, which I use to make the financial choices of my life. And I feel that this can really help somebody who's in their 20s, take a call at what they want to do and how they want to approach their finances. So, before I give you the financial blueprint which I have in mind, we need to first get some context. Note that I'm not someone who is an investor or trader by profession, and I have a job which is unrelated to finance. I have a social life and interest which basically make it impossible for me to continuously check some stock portal or continuously think about my bank balance. I'm not interested in that, right? I am a normal guy who has other things to do. Uh, so even then, I have some fundamental understanding of how different financial instruments work, and I think we should visit that. Through all the books and media that I've consumed, I've realized that in any country, the way of growing wealth as a working class member of the society are relatively fixed, and there are predictable rates of returns and taxations associated with each of those instruments. Now, some instruments might be region specific. For example, 401ks are specific to America, or these post office monthly income schemes which run in India, they are India specific. But generally, approximate equivalents can be found in most other countries. For example, EPF in India is similar to the 401ks that you find in America. Then there is the distinction between the different instruments based on whether the instrument derives its inherent value from debt, or does it derive its value from equity based sources, right? So the fundamental difference between the two is that debt involves somebody borrowing money from you, maybe a government or a company, to pay that money back to you later with some appreciation. And then there is equity based thing, which basically means that somebody gives you certain shares in a company and you hold on to them hoping that their value by the market will be later on at some greater later on at some point in time. And then there are also mixed instruments. There are certain funds and stuff which kind of manage the wealth for you, and the shift in the ratio, are they more reliant on debt, or are they more reliant on as stocks? That kind of also adds some variations, but this is the general idea that these are almost any financial instrument can be put on a spectrum between debt and equity, and then there are maybe derivatives and stuff on top of that, but let's not go into that. But the key thing to keep in mind from the above discussion that we had, right, the previous discussion that we had, is completely radical and fundamentally different financial investment opportunities are very rare to come by. I guess something like a Bitcoin launch, which happened in 2009, which kind of kicked off the cryptocurrency movement, is one of them. But really, how many of such completely novel sort of investment opportunities do you see in one lifetime, right? Not so. The mental model that I have is that given the limited novel investment opportunities which you see in a lifetime, right? Which if you ignore, minor fluctuations between different providers and these transient market trends, one particular mutual fund house might be doing better than the others for some time before it falls off and somebody else takes over. If you remove those minor fluctuations, I see diminishing returns on overconsumption of media regarding finance for non-financial people, right? Uh, in fact, there can be a bigger problem if you consume too much information, in my opinion, because it may cause you to get greedy, right? You might think, okay, how can I get a mutual fund? Maybe there is some mutual fund out there which I'm not aware of, which gives 40% CAGR, right? And you chase that, but it turns out maybe it's a scam, right? And in hopes of magnifying your wealth, you actually end up doing more harm than good. So I see a very diminishing return on reading too much on finance if you're a non-financial person, right? Ideally, you want this stuff to run on autopilot for you. So the only things which you really need to take care of, I can basically break it down into a three-step process for everybody. Uh, and this approach also makes sure that you don't lose the money you ended up saving overnight by an accident or a disaster, right? I like to think of the path to financial freedom as three non-overlapping ordered steps. You only move to the next step once you complete the previous one. Uh, the number one step is insure. So I have worked in insurance in the past, and it's a very interesting industry. And no matter how hard you work to make money, right, there are some events and risks in life which have the potential to wipe out all your savings and even push you into debt, possibly, right? Stories of people developing chronic diseases or meeting an accident which forces them out of work for unspecified periods of time are not unheard of. And while it's good to have an optimistic viewpoint towards life, the cost of ensuring invaluable things like your health, life, and house are laughably low compared to the cost of building these things from scratch, right? And it makes you tension free about having to dip into your funds when such incidents strike, right? The second step that you need to be uh, wary of securing. So after you have gotten your basic insurances in place, for people like me, generally what the thing that you want to buy first is a health insurance, because at your age you possibly don't have kids and you don't really have any dependents in that sense. So life insurance is not that useful. So not saying that you shouldn't get it, but the order in which you should get it is get health insurance first and then consider other insurances like life insurance and vehicle insurance. But step two is oriented towards self insuring. That's why I call it securing. Not all risk can always be insured. For example, employment, while it is guaranteed in certain countries, and if you don't have employment, they pay you a certain amount, minimum. But it's not guaranteed in many countries, and there are not even reasonable insurance products available for loss of jobs in certain places. Um, Another example where you could possibly require some wealth on you, not in form of insurance, is, let's say, a transient dip in your equity markets and assets which you have, right? So let's say if the stock market collapses tomorrow, something like a 2008 happens, and you find yourself in a pinch, you will be forced to sell your positions. At rate of interest on the emergency fund is relatively less important, because as long as it beats inflation, you can be ensured that if you have, let's say, 6 months of your recurring expense stored in an emergency fund, then if it is beating inflation, there is a high chance that you are set for, let's say, the 6 months or more, even if you lose your recurring sources of income. Or let's say if the market takes a dip and now you cannot sell your assets for a good value, at least you don't have to sell them for the next 6 months, and hopefully the market would have recovered by that time. The reason that I'm saying that you should buy insurances and do step one before building an emergency fund is quite simple, right? So for most people, the amount needed to buy annually renewed insurance policy like a health policy is generally much lower compared to the money that you would need to put in an emergency fund. Uh, so for most healthy young people, you can even get, let's say, I guess a 10 lakh per annum sort of a insurance cover for less than 10k, less than 12k. And they are very good insurance policies, the ones that I'm talking about. But you can obviously get it for a little bit cheaper if the insurance provider is lesser known. Um, and if God forbid a disaster strikes, a health issue can deplete your whole emergency fund and more anyways, right? So you have two options: either save 6 months of your recurring expense, which could be anywhere between, conservatively being, from 2 lakhs to 6 lakhs, or however much higher you want to go, or just pay 10,000 a year for the first few years. It's your call, but I would obviously say buy insurances first, because if some disaster strikes, all that money which you save would be for nothing. So now that you have these basic things which secure you from even the worst of circumstances, it is at this point that you can start thinking of really, really growing your wealth and, I guess, preparing for retirement and old age. And that step is what I call magnification. Uh, so once you have the previous two steps out of the way, we need to understand that we are privileged. Uh, when we are young, we have this huge opportunity and an advantage over others, which is the advantage of time. And we tend to underestimate the effect of compounding and the greatness that we can achieve by just small improvements on a continuous basis. See, compound interest is the key player behind any strategy for growing wealth, right? And aided by the power of compounding, I see just two key ways to magnify wealth, and both require compound interest. Number one, compound interest applied on monthly wages, which is generally the recommended approach and what most people would like to follow. And the second is compound interest on front loaded gains. which is a much more powerful technique, and I'll explain what I mean by that. So if you look at this chart, which I have put in my article, it basically talks about $100,000 invested in chunks, and $100,000 invested upfront for 20 years looks like after the 20-year period. And while if you invest in chunks of $5,000 every year for 20 years, the amount of money that you get is a little over $400,000. But if you, let's say, somehow figure out a way to get that $100,000 upfront invested and keep holding on to it for 20 years, then given the same rate of interest and the same time period, keeping everything else same, you will end up with close to $1 million, right? And this gap will only keep increasing with time. So this is what I mean by front-loaded gains. And this is basically a fork in the road, right? I think you can guess where I'm headed with this. When we talk about financial goals, most people just aim to live a comfy enough life in their younger years, maybe go out a bit, eat whatever they want, and watch movies and being able to afford all the Netflix subscriptions and stuff. And that's, I feel, good enough, right? If it makes you happy. And then what they hope is that by the age of around 60 to 65 years, they would have grown their net worth to such an extent that they can start now dipping into it instead of having to work for money, and replace their recurring income with stable deductions from their nest egg. In order to accomplish this retire by 65, 70 sort of a scenario, compound interest applied on top of monthly savings are more than sufficient for what most people want. And I've dug a little bit deeper about this in my article, and consistently investing each month tends to have a cost averaging effect if you think about it. Some of the months when the market is bullish, stocks will be more expensive in general, and your money will be able to buy less of them for the same price. But buying more when the market is down has a lot more advantages, right? Because then you can buy more units, and once the market bounces back, you'll be seeing a huge gain in your portfolio. And also your ability to invest tends to increase over time as your income increases, provided you of course don't match that with an equivalent or more increase in your living standards, which now basically leaves you with lesser money net. And over the long term, instruments like stocks and equity funds, index funds, stuff like that will give you easily 10 to 20% compound annual growth rate, at least in India, which is good enough for retirement planning for most folks. Another issue which I notice in this is that excessive marketing of stocks and mutual funds in the last decade, along with the ease of investing with these online apps which have come around, right, has made youngsters jump the gun and dive into these without paying attention to the previous two steps which I highlighted, right, insuring and securing. Uh, Today, when I talk to people my age that I meet, all of them have more money invested in stock markets with little to no liquid or fixed growth sort of deposits. But what this essentially means is that they'll have to rely on their parents, or let's say take credit card debt during rainy days, or when their stock market portfolios are down. Something which I'm not in favor of doing. You should always have the emergency fund in place first before you invest in stocks, in my opinion. So you can use the financial instruments I mentioned so far, right? And consider your risk appetite, and constantly pump whatever money that you have left at the end of the week, when your salary arrives and you have paid off your bills, and now you have rough idea that okay, this much money I am saving each month. Keep putting it into these sort of different investment instruments, and you should be good for the most part, because you're pretty young and you're just starting, and your income will only increase with time. This is a good enough approach, right? And another thing that you can do is that you can split your life into different goals, some short term, some long term. So for example, if let's say you're trying to plan for a marriage or buying a car, which is let's say in the next 5 years horizon, you can go for a fixed return style of assets, because you don't want stock market to collapse and take away all your savings right when you're about to buy the car, right? So for this, arbitrage funds and stuff are much better options. But if for long-term goals, for example, buying a house or planning for retirement, you can go for slightly more risky assets, which are better suited for. Uh, so you can go for slightly more risky assets like stocks and mutual funds. So as your goal horizon increases, you are expected to make peace with risky assets, which intermittently will take a turn for the worse and then will restore back to normal or even higher levels, with the belief that in the long run your money will grow. And practically speaking, it does tend to grow at much higher rates compared to fixed income assets. So if you have a 20-year period, you're not retiring today, maybe let's say you're retiring in the next 40 years, you can trust that, if you have trust in this country's economy, that it will grow. And if, let's say, even if you only invest in nifty, it has to go up over that such a long period, right? But the more interesting thing is compound interest applied on front loaded gains, right? Sure, compound interest can turn a dollar into millions given enough time, but how much time do you really have? Will you be able to enjoy your with as much as today, right? If you're older, can you really go skiing and do all these physical activities and stuff like that, right? Even if you have the money, you probably cannot do this stuff that easily. And what if you die? What if you don't make it to your 70s and all of that money saved would be for of no use? This front loading is huge and only widens year on year, and incremental investing just can't keep up after a point. And this is the advantage that basically every entrepreneur and every business provider has, right? They put in their effort and their time in their initial years and generate large sums of money for themselves in a time which is much shorter than what the average person takes to accumulate that much wealth, right? Some take their whole career and do not make the same amount of money, which then allows them to apply compound interest on a much higher sum much early on in their life, right? And if they're smart with that money, it will really take them to filthy richness later on, right? Because it's the same compounding effect applying on a much larger starting amount. I mean, you could also do the same if, let's say, you inherit money from your some relative or parents, but let's leave out that scenario because a lot of that is not in your control. And this is the core idea which is popularized by MG DeMarco in his book The Millionaire Fast Lane. uh, it is fine if you don't want to be filthy rich. I mean, as long as you're not hoping that a 9 to 5 and compounding alone will get you there. uh, on the flip side, if your goal is to reach that pinnacle of financial freedom, I would suggest that you consider your options and evaluate if the path that you're currently on is good enough to take you to your desired destination, right? To conclude, no matter what your decision is regarding the final fork in your road to financial planning, the first two steps of the blueprint ensure that you don't completely endanger yourself at any point. Doing the first two steps, which was insuring and securing yourself, well, they might even give you the courage to take the plunge and take up entrepreneurship, because with the correct insurances and a big enough emergency fund, you will have the confidence that you can survive for months or years even in very perilous circumstances. If you don't have insurance and emergency funds in place, your number one priority today as a youngster should be getting these in place, right? uh, I hope you found this brain dump useful. If you have any other questions, feel free to contact me on LinkedIn, on X. You can also book a call with me and discuss with me whatever's on your mind and see if I can help you in any way. So yeah, thank you for watching this video. I'll probably see you next week with a different topic